Well, good morning and welcome to the Reserve Bank. With me I've got John McDermott, who's the Assistant Governor and Chief Economist. As you know, the Reserve Bank today left the official cash rate unchanged at 1.75%. The global outlook has improved, but major challenges remain with ongoing surplus capacity in the global economy and rising geopolitical uncertainty. Global inflation and long-term interest rates have increased. New Zealand's financial conditions have firmed, with long-term interest rates rising and continued upward pressure on the New Zealand dollar exchange rate. The exchange rate remains higher than is sustainable for balanced growth, and a decline in the exchange rate is needed. Economic growth has increased as expected and is steadily drawing on spare resources. The outlook remains positive, supported by ongoing accommodative monetary policy, strong population growth, increased household spending, and rising construction activity. Recent moderation in house price inflation is welcome and in part reflects loan-to-value ratio restrictions and higher mortgage rates. It's uncertain whether this moderation will be sustained given the continued imbalance between supply and demand. Headline inflation has returned to the target band and is expected to return to the midpoint of the band gradually. Longer-term inflation expectations remain well anchored at around 2%. Monetary policy will remain accommodative for a considerable period. Numerous uncertainties remain, particularly in respect of the international outlook, and policy may need to adjust accordingly. So happy to take your questions.
Is there some sort of mixed messages for New Zealanders at the moment that with fixed interest rates seem to be rising, but you seem to be signalling that you won't be raising rates for a number of years? What should Kiwis be thinking?
I think the way we look at it is the economy is growing well. It's growing at around 3.5%. We've seen very strong employment growth, averaging 3.5% in the last 3 years. And we believe that having now got inside the band because of oil price rises as much as anything else, that inflation will continue to increase towards the midpoint. So what does that mean for monetary policy? What we've adopted is very much a neutral bias. If you talk about bias and stance of monetary policy, if you go back to November, we had an easing bias, a slight easing bias built into the forecast because we had a 20% probability of a further OCR cut built in. Now we've removed that and we're in essence saying that if you look at the risks around an OCR increasing or decreasing, we think that they're evenly balanced. But if you look out in the very longer term, and if this set of projections, which is always highly conditional, if it turns out generally along the lines that we're forecasting, then over time, and perhaps 2 years or more out, we might start to see as the cycle matures further that OCR increases may be needed. But we've built in one increase over that time. Now in terms of mortgage rates, what does it mean for that? You've seen fixed mortgage rates, say 2-year mortgage rates, increase by around 0.5%. And a lot of that has come because lending growth of banks was exceeding the deposit growth of the banks. So that meant that the banks, in order to fund themselves, either had to raise deposit rates or they had to go to offshore financial markets, to the wholesale markets, to get that funding. And those offshore wholesale rates were rising because long-term interest rates globally were rising, and a lot of that was linked to the movement in long-term interest rates in the US. So if you put that together, and forgive me, it's a long answer, but it's such an important question. If you put that together, then we've seen mortgage rates having increased. They look as if they've stabilised more recently, but the long-term outlook for mortgage rates will very much depend upon what happens to long-term interest rates, and that will very much depend upon what happens globally, but particularly in the US, and where US goes with fiscal policy, amongst other things.
Sorry, I'm going to sort of follow that up now with a slightly different question than what I planned when I first put my hand up for this. That uncertainty, that seems to be very much around the Trump administration and the unpredictability around that. The word that seems coming through here, even more than usual in one of these statements, is uncertainty. Mm-hmm. And I'm wondering how much of that is firstly around the somewhat unpredictable nature of the new administration and where that might be heading.
Yeah, I think that's a very fair question. If you look at various indicators of uncertainty in financial markets, and there are some very good indicators that suggest that uncertainty has been picking up in the last few months. Doesn't seem to be coming through quite as strongly in terms of measures of market volatility. But if you look at what are the big risks out there, then clearly there's risks around Brexit and the negotiations and the triggering of Article 50 by the end of March, and debates about what that means for the British financial system and particularly the banking system. But the biggest risks are around the US, plus also China in terms of their debt position. But if you go to the US, I think the biggest risk is primarily around protectionist policy. If you look at the statements around TPP, or TTIP, where these negotiations between Europe and the US about harmonisation of standards and investment treaties and trade, which was really very promising under the Obama administration in terms of those discussions. You look at the potential for renegotiation of NAFTA, then you could end up with a situation, if it were followed through, of higher tariffs, and what would that mean to the global economy? So let's say, for example, the US really did get serious about imposing 45% tariffs on China, for example, or large tariffs on Mexico. Then that would have serious implications, I believe, for the global economy. Because for one thing it would do, it would raise inflation rates in the US. The Federal Reserve would need to push harder against rising inflation, so those interest rates would rise. The exchange rate in the US would probably rise. You'd see retaliation by other major countries. And the OECD did some work on this recently, basically looking at what would be the impact if costs associated with trade, so i.e. tariffs, were to rise by 10% in China, in the US and in Europe. And not unexpectedly, it led to a very significant slowdown in global growth, higher costs associated with trade, reduced volumes of trade, and slower growth in the rest of the world, which would certainly affect us. So the biggest risk, I think, is the protectionist risk. And it's unfortunate that a lot of this rhetoric is taking place at a time when we've seen the slowest growth in merchandise trade volumes in the last 5 years than we've seen since the early 1980s. The other risk out there in terms of bond markets and therefore interest rates is what the US does on fiscal policy in terms of the potential for tax cuts, infrastructure spending, and then increases in operating spending, such as around the military and other things that have been identified. Did you want to add anything, John?
If you're interested in policy uncertainty and measures of policy uncertainty, I'd encourage you to look up the website for Nick Bloom, who has a measure of this policy uncertainty. It's very good, actually. And actually, right now, what we're seeing is it's touching record highs, and it's reflecting the political uncertainties in the US, in Europe, and so on.
The other thing that seems fairly strong here, and I know it's related to that, is the New Zealand exchange rate. And you mentioned in your opening remarks that that's still out of balance with where it should be. Mm-hmm. What I was wondering today was, and I suppose is asking you to do two very large things, but one is setting aside the exchange rate if it was roughly where you think it should be, and maybe as well setting aside the Trump thing, and it's an even bigger thing to set aside, I guess, where you might be heading with interest rates right now.
Where we're heading with policy interest rates?
Where you would be if the exchange rate was roughly where it would be. If the exchange rate was roughly where you think it should be.
Well, I think what we've seen is we've cut 7 times since June last year, and the exchange rate's 7% higher than when we started. So if the exchange rate were, let's say, 7% lower, then that would be beneficial clearly in terms of higher tradables inflation. So you'd have to think through what that would mean to overall inflation, headline inflation. You'd be thinking through what it would mean to the tradable sector, what would it mean for export volume growth, and therefore aggregate growth in the economy. So you'd be looking at a lot of things. You'd be looking at how fast is the economy growing, what is it doing to the output gap, what is it doing to inflation pressures, and you'd be starting to then work out what does that mean for current inflation and the projection in terms of when it would hit the midpoint of the target. But let me see if John wanted to add anything.
Well, the other part of your question was on Trump and uncertainty, and I think the general approach is the more uncertain things are, and you can never set them aside, but the more uncertain things are, I think what you do is, when you're thinking about policy, is you go a bit slower, you're more circumspect, and you just wait for the developments to unfold before you move on the strategy. It doesn't stop you having an optimal plan, but you'll move there much more slowly.
Governor, as you reflect on your tenure, do you feel like you've done enough to head off the financial instability from high housing prices, and are you planning anything more before you finish?
Well, not dead and buried yet, so we've still got 7 months on the job and lots to get done. But we've always been very clear that we can't take ownership or fix the housing problem in terms of housing affordability, supply and demand imbalances in the market. We know the forces that are operating on the demand side very well. We know them on the supply side. What we have been able to do, and I think it has been very successful, is introduce macroprudential policy in terms of loan-to-value ratios. Now, when they were first introduced, the chief executives of the banks were cautious about these. They didn't want them introduced for a number of reasons. They were worried about financial disintermediation, amongst other things. But that attitude has turned around completely, and you find the chief executives of the banks are very supportive and have been very public about loan-to-value ratios and what that has done to improve basically the credit quality of their balance sheets, which really was the prime objective. If you look at house price inflation now, you're starting to see quite a lot of moderation in house price inflation. Now, it remains to be seen whether that will continue. But if you look over the last 5 months, so take the period from July to November, then house price inflation countrywide is growing at about 0.1% a month. So 0.5% in the last 5 months, or in that 5-month period. That was compared to 10% in the previous 5 months. So that's a major slowdown. If you look at it for Auckland, house price inflation in the last 5 months has been growing at 0.3% a month. So say 1.5% or so over the last 5 months of data. So that's an important slowdown, and we're very pleased to see that. We've always said that supply is the answer to solving the issues around the housing situation, and we are seeing more supply come on stream, and that's good. I mean, if you look at permits for New Zealand as a whole, look at them for Auckland as a whole, they're at an 11-year high. That's significant. They're both up about 12% or so over last year, but we still need to see more supply. As you know, we approached the government to see if we could have debt-to-income measures introduced into the macroprudential toolkit, and the government's made it clear, and we're very encouraged to have a response. It's made it clear that, look, they would like us to go and consult on that, and we'll certainly do that. They've asked us to be very clear about the costs and benefits of that instrument, and that's something that we're also very happy to do. We've also been quite clear that even if we put that in the macroprudential policy toolkit, we've indicated that we wouldn't necessarily use it at this point in time, because we have been encouraged by what we've been seeing about this house price moderation.
Governor, you mentioned the potential inflationary risks of protectionism and what the US President might do with fiscal policy. Mm-hmm. Would the Reserve Bank look through an inflation shock caused by policy changes in the United States and responses around the rest of the world, or might it have to actually respond by tightening policy here in response to that global inflation shock?
Well, it depends how much of an inflation shock it would be, and whether it's transmitted, how widely. Because given the mandate of the Federal Reserve, if there was a large fiscal stimulus in the US, then the Federal Reserve would certainly lean against it. And as you know, their dot path is for 3 tightenings this year. Now, whether that would change once those fiscal plans are public and in the House, that will, I'm sure, depend on the magnitude of that fiscal impulse. So it'll be interesting to see, as those plans become clearer, what happens to long-term rates. If you look at long-term rates in the US, by and large, after a period of time, they seem to get fully mapped into long-term rates around the world. Sometimes it's very quick, sometimes it can be within a quarter, but by and large, they do get transmitted. So it would very much depend on what happens in terms of global interest rates, long-term rates, what happens to inflation, and does that feed through to other countries. But John, did you want to add to that?
Maybe again, we'd be watching the persistence of that shock, how long it lasts, and I think the most important thing is whether it changed inflation expectations and behaviour in New Zealand, because if it did that, clearly we'd have to lean against it.
Just on the DTIs again, Minister Joyce yesterday said that he had talked to you guys about work that you've already done on it. Would you be in a position that if it were in the toolbox now, would you feel comfortable using them if you had to, or is it still the bank's feeling that the bank still has to do more work on them?
Well, we have been doing more work on them. We've been collecting a lot of data from the banks about DTI exposures and getting a lot of assistance from the banks. The normal course of event would be, let's say this was already in the toolbox, and we felt that it was appropriate to introduce this tool, then we would be having discussions with the Minister, we'd consult the Treasury, and we would go out in the normal course of events with a consultative document which would outline our proposal and the costs and benefits and the risks and the goals that we're trying to achieve with it. So that would be the normal course of events. But as I say, at this point, we wouldn't be introducing DTIs if we had the ability to do that.
Sure. I think what we're trying to figure out is whether it's sort of kicked into touch at all, because it sounds like that's not what happened with the loan-to-value ratio policy. Minister Joyce said it was done slightly differently there, and I just wondering if there's scope for that same process to happen here, though.
Well, when we introduced the MOU, and that was between the Minister of Finance and myself, then that contained 4 instruments, and that was agreed in terms of that particular toolkit. What Minister Joyce is saying is look, he would like us to go out and consult whether it's a good idea to include DTIs into the toolkit. Now, that's a position that he made clear at the FEC yesterday. We're happy to do that. We're happy to have clarity about the government's position. And he's asked us to look at the costs and benefits of alternatives.
You mentioned earlier inflationary expectations, and I noticed that this week they came up quite a bit. Of course, when you started cutting before, that was one of the triggers. And I wondered if you're putting a little bit less weight on the inflationary expectation survey than maybe you were when you started cutting?
No, it's a good question, and get John to offer his thoughts as well. I mean, we look at a range of measures in terms of inflation expectations. Some are market, some are expectation surveys, some are model driven. What did surprise us, and we've talked about this before in the press conference, what did surprise us back in March was the extent to which 1 and 2 year inflation expectations fell. And that not only was it 1 and 2 year, but it was essentially along the curve. So it was longer term inflation expectations as well. So that, as I say, that surprised us at the time and worried us, because could that continue and what would be the implications if it did and fed into wage and price setting and therefore into actual inflation outcomes. So that was why we cut in March. And we'd talked about that as some investors understood and others didn't. We'd talked about that risk in a speech in February. Now, if you look at measures of core inflation, they're basically running at around 1.5% to 2%, and long-term inflation expectations are stable at around the midpoint of the range at 2%. So we're very comfortable about that. Pleased to see shorter-term inflation expectations rising. But John, did you want to add things?
Yeah, let me emphasise that the move we've seen in short-term inflation expectations have been exactly in line with what we anticipated as we move back to the target band. And that move is consistent with the bank moving towards the middle of the target range over a period of time and not rushing matters. And that's very different to what we saw in March, where it wasn't just one indicator that moved, it was pretty much every indicator of inflation expectations were falling rapidly at every single horizon.
Another question. Your assumptions around consumption growth and saving or dissaving. There's been a pickup in the last, in recent times, in consumption growth, perhaps wealth effect from housing, perhaps other factors. You've got it coming back a little bit, but not back to pre-2012 levels. I'm sort of wondering if house prices continue to stay high, and if those wealth effects continue, if that might be a bit of a heroic assumption given New Zealand's long-term dissaving record. Yeah,
there's quite a lot of uncertainty around consumption track. Consumption's been stronger in the last 6 months than what we're anticipating. Now, whether that's linked to just a different spending propensity, whether it's linked to wealth effects, but house price inflation, as I said, has come off, slowed quite dramatically in the last half of the year. But there is a lot of uncertainty about that, and you're certainly right about the dissaving record of New Zealand households. But John, did you want to add to it?
Yeah, at this point, I think it could go either way. We've seen some recent increase in consumption over the last few quarters. We've noted it. We think it will, over the medium term, moderate. But we've acknowledged that the savings rate will probably slide from a small positive to a small negative. And you will note that we've considered the different risks, and that is one of them that we've highlighted in the back of the document in the risk scenarios.
Just wondering if you'd given any or have any views on why wage growth seems to be so sluggish, appeared to go backwards in the December quarter by one measure. What's going on in the New Zealand economy that we aren't getting reasonable wage growth coming through?
Yeah, it's a very good question. I mean, you've seen employment growth averaging 3.5% over the last 3 years. You see labour force participation now at 70.5%, historic high. So it's a very good question. Why aren't you seeing the wage pressures start to develop more intensively? I think there's a couple of reasons, and one can never be sure on these things. But I think one is what's happened to the growth of the labour force. So if you go back to the start of this migration cycle in 2012 or thereabouts, then the migration in terms of working age population has been around 190,000. So that's about 5.5% increase in the labour supply, which essentially pushes out the labour supply curve to the right, if you like, for a given demand. And that in itself will start to put downward pressure, or at least moderate pressure on wage rates. I think the other thing is that it's quite likely that expectations have become more adaptive, so more backward looking. So wage and price setters have seen low inflation, which is partly triggered by negative tradables inflation. We've had negative tradables inflation for 5 years, but they've seen the low inflation, and that gets reflected very much in their wage demands or what they're able to achieve. So I think there are two factors that account for some of it. But John, am I missing a few?
Well, the only other point I would highlight, if you think about real wages, they have been positive. So wages adjusted for inflation have still been positive. And it's the link between real wages and productivity that in the long run really matters. And given that productivity has been pretty sluggish, you'd expect reasonably sluggish real wage growth.
Governor, I was just wondering why you decided not to seek a second term. Was it just, and it seems like that was always the plan, was that just a question of age, or is there something else going on there? And also, can you reflect briefly on some of the highlights and the biggest challenges? Again, given that you've got another 8 months to go, I realise that.
I'll leave the reflections to when I finish. No, these wrinkles and grey hair are well earned, if you like. When I took the job, I went to and the finance minister talked to me about the position after the board had made a recommendation. I said to the finance minister, Bill English at the time, I said, look, I'll only serve one term. Because I'd left some business opportunities that I was doing in America. I was doing board work in Europe as well. And I felt that at my age, I could come here, make a contribution for 5 years, hopefully, and then move on to other things. So that's really why I'm moving on. I want to go back to some of the work I was doing in Europe, and also do some board work in Australasia. and also hopefully work, hope it's not sounding self-serving, but also work fewer hours.
Governor, could you say if the government's decision to get you to do a cost-benefit analysis on a debt-to-income multiple is going to restrict you in any way if, as we've seen in the past, the housing market comes to life again in a bit of a hurry come February, March? Will you not have the same flexibility that you had to react quickly with the loan-to-value ratio tool, which was in your toolkit?
Well, I think if you say, would our preferred position be that we have this already in the toolkit, that would be our preferred position, so that we could respond in that situation. But the government, has been clear that it wants a consultation on that. We would normally, as I say, consult when we were about to introduce it, but it's asked for it up front, and we're happy to do that work.
Governor, the market's been pricing in a rate hike earlier this year. Are they ahead of themselves, or is your OCR track realistic given some of the uncertainty out there and the prospect of US rates going perhaps more aggressively than the 3 hikes priced for this year?
Well, the market, as you know, the market often likes to get out in front and lead, and was suggesting to us that we should drive the interest rates down towards zero, and now they're suggesting that we should be quick to raise rates. So we think the market assessment has got a bit ahead of itself at this point in time. And as I said in the comment to the first question, we think that the risks are basically evenly balanced. We're happy with the track that we have. We think that a neutral bias, if you like, is the right situation, is the right position to have at this point.
Just on the decision not to seek a second term, was there a particular urgency behind your need to step down? What were you asked to stay on for another 6 months? And clearly, the indications are that Grant wanted to retire, and now he has to stay on another 6 months to be acting governor.
Well, the situation didn't come up because in essence, I think the government's been clear about, what it saw as a conundrum, if you like, with the timing of the election. And the government has every confidence in Grant, given his outstanding skills and his experience. And I had always been clear. That I would leave after one term.
The CPI rate, expected CPI rate over the short term appears to have dropped a bit from November. Are there any key reasons for that?
We're just looking at the price of global commodities. We're looking at what the exchange rate's doing. It moves things around, and relative to November, the change is pretty small.
Governor, and again, you tried to talk down the currency this morning, and 7% higher than when you started on the easing cycle. The TWI was touching 80, I think, earlier this week and has been leaning up against it. Are these conditions ripe for intervention?
Well, we do have criteria for intervention. We've got a traffic light system with four conditions, and we do look at those conditions regularly. So I won't go further and say where we are, but we do look at those things closely, and certainly before each MPS is finalised.
Governor, given the change in governorship and the election this year, does that make you more cautious about changing rates?
No, I don't believe so. The central bank has a mandate. We take it very seriously, and if we felt that we needed to change rates, we certainly wouldn't hesitate.
Governor, in the monetary policy statement, there's a box that talks about migration, and that surprised us all in the last couple of years. How does the bank think about what another migration shock, continued higher than you were forecasting here, how does the bank think about what that might do for monetary policy? Let's say we have, yet another 2 years of 80, 100k plus of net migrants.
Well, you'd certainly think, hand on to John, but you'd certainly be thinking about the composition of that migration. And the composition of those migration flows, for example, in this cycle, is quite different from the cycle in 2001 that kicked off, where it did feed through into house price inflation very, very quickly. A lot of returning families, for example. This composition's different, more students, more people on single work permits, so you'd have to think through that. You'd have to think through what does it mean for the aggregate supply and aggregate demand position? What does it mean for wage outcomes? What does it mean for house price inflation? So you'd be thinking about all those things when you're looking at the output gaps and things that we look at very closely. But did you want to comment, John?
That's the answer I would have gone to. But let me emphasise, the question you've asked is probably the wrong question, because in terms of pure numbers, it's been unprecedented and genuinely surprised everybody, but it's made almost no difference to monetary policy. And it's because it's composition that matters. And that's what we've really learned. It's the age demographics, it's where they've come from, or whether it's Kiwis coming back. And because that matters between the demand and supply response that they deliver into the economy. And there's been just more people entering the workforce from the current net migration flow that we've seen than in previous cycles. And that's what's really important. So you have to really do the analysis to understand what sits behind the move, not the actual numbers themselves.
So if the composition was the same in the next couple of years as it was in the last couple of years, probably wouldn't make much difference to monetary policy.
For monetary policy, yeah. Might make difference for lots of other things, but not monetary policy.
It could make a difference on macroprudential policy, for example.
Could you elaborate on that?
Oh, I think it's fairly clear. If you found that house price inflation started picking up again, I mean, if you look at house price to income ratios, and we know the numbers very well. Auckland, that ratio is close to 10 now, 5.5, 5.25 for the rest of the country. We know where they rank internationally. So at the moment we're seeing, as I say, house price inflation starting to moderate. We're starting to see loan commitments decrease. I mean, they're down, for example, 2.5% in the last 12 months, down about 14% for investors in the last 12 months. So that's important. But if you started to see those ratios deteriorate, house price inflation accelerate, and linked to strong migration flows that just look as if they were going to go on and on, then you would certainly be looking at macroprudential intervention.
Isn't that quite likely though? Because to put it another way, isn't this just a lull? Because you've got, you made the comment earlier that supply is the core issue, but supply is still not catching up with demand. And given the global uncertainties which you've talked throughout this, isn't this just a lull in those migration and those house price pressures?
It's hard to say. I mean, we haven't been successful, to put it mildly, in forecasting migration. We find it as hard as everyone else. We can forecast one element of it pretty well, which is the departures, which are linked by and large to the relative labour markets between New Zealand and Australia. It's the arrivals that fool us all the time. And we look for signs of changing composition on the arrival side. We've seen some of it in terms of student numbers. We're starting to see an older cohort come in, people around their middle ages rather than younger people. But migration, you're right, it could well continue for quite some time, and we'll have to watch that very carefully.
If you do have to reach to the toolkit if migration pressures continue, etc., as you mentioned, what would you look to use then if you don't have the DTIs there?
Well, there are other instruments, and we'd have to reflect on that internally and see whether one was appropriate to use macroprudential instruments. We've found that a lot of countries have used DTIs, and they can be very helpful. If managed well. There's always unintended consequences with any form of regulation. We'd have to look at whether we wanted to look at capital issues, for example, the amount of capital that banks had. We'd need to look at LVRs. And, interest rates might be in a different configuration if we're in a completely different world, so they may be able to play a role as well in terms of moderating housing demand. So it depends on a lot of things. One of the things on loan-to-value ratios is, we've tried to anchor these as best we can in terms of default history. And often it's default history looking at other countries like Ireland and elsewhere. So we don't want to break the integrity, if you like, of the sort of underlying sort of foundations of that particular instrument. So we'd have to think carefully about what particular tool we use.
You've previously, I think Grant Spencer did, in this area also, as well as your own toolkit, suggested the government could pull a few more things out of its socket set in the immigration and the tax area. And I was wondering if you'd given any more thought to that, particularly in the context you're obviously discussing DTIs and the way of doing that, if any suggestions were being made over the road that perhaps they could do a bit more too.
We've not been talking to the government on supply measures lately. The government's aware, I think, of the issues around the productivity in the building sector, the construction sector. It's aware of the issues around regulatory delays and the costs of those in terms of planning permissions and the like. But we've not been talking to the government about tax measures or anything.
Governor, an exciting question about productivity. It's been so low in New Zealand for a few years and seems to be a trend around the world of low productivity. Mm-hmm. When does it start to worry the Reserve Bank? Because if you have continued low productivity, eventually that creates a problem for inflation. When do you start to worry about productivity in New Zealand?
Well, I think it's a cause that lots of policy advisors around the world already worry about. New Zealand's had a history of, if you compare it with other OECD countries, of being in the bottom third in terms of labour productivity. Now, some of that seems to be linked to issues of distance and size, but that's not all of it. Some of it's linked to the amount of capital per worker. Some of it's linked to the vintage of that capital per worker. And we've also seen total factor productivity that's been weak as well. A lot of the employment has been coming into the construction sector, and we know from the work done by the Productivity Commission that the productivity of the construction sector in New Zealand is 25% below that of Australia, which is no great shakes compared to the States. So there are all those considerations. Want to add anything? Well, thanks very much indeed.